Hi, everyone, and welcome to September's Daily 5 with Rachel Ackley, the host, and StockCharts TV, of course, being the wonderful group that puts this together for you all. Lots to talk about as today is a continuation of the rally we started to see last week. We always, when we come to the stock market, we always have to think forward and not past or even current in essence, because essentially what the market is relaying to us right now is that things can't get much worse, so they can only get better. And we know, of course, that can switch very easily to, okay, things are getting better, but could they get much better? And that, in essence, is the whole complexion, if you will, of stagflation and trading ranges. We've seen this before in the 70s, and here we are seeing it again. So the question is, how much further can we go? Which is why I'm calling this segment Key Outliers to Watch this week, because I think rather than give you stock picks or worrying about people having fear of missing out or getting short prematurely, these indicators will really give you all the information that you need. And here's what we're going to cover today: the bonds, the dollar, the junk bonds, the gold, the oil, and of course the transportation sector. So let's get going. So let's start with the bonds. And the reason why the bonds are so critical is, first of all, September 21st is the next Fed meeting. The market seems to be pricing in about a 75 basis point raise. And the real question is going to be, will the Fed continue its aggressive stance, considering we have CPI coming out this week? The expectations for it to be softer. Certainly, if you just look at prices of things besides gas, I mean, here's my classic example. I went to buy a case of Pellegrino about a month ago, and they wanted $33. Went back into the store this week, and it was $23. That's a 30% discount, actually. So that should be the softer CPI that people are expecting. But we do have other situations to deal with. Obviously, Mother Nature and drought is still a factor. Geopolitics could still be a factor, and the potential of a railroad workers strike, and that will certainly be disruptive. So right now, what you want to see with these TLTs is holding these levels. And look how nice this actually held up if we look at these lows. So if we go back on TLTs to the recent low and then look back at the June low, we actually made a lower low after the Jackson Hole debacle and Powell's very, very hawkish stand that we will break the back of inflation no matter what. But nonetheless, right now, with this sort of current consolidation, I think it's pretty clear that, number one, it is well underperforming the SPY. You know that that's usually a good thing in terms of you want to see the SPY outperforming the yields, but on the same token, of course, you don't want to see the yields get too high and the SPY as a result start to fall. There's a delicate balance, and that's what the soft landing is going to be all about. Can we achieve it? But we also had a bit of a mean reversion in price, obviously not in real motion. We're obviously seeing no divergence here. So I'd say if we can get back through 110, then that probably means that more rally for the market, particularly in the growth area. And of course, if we break down under 107, the recent lows, then that would mean a much more hawkish stand, and that would certainly not be good for our growth stocks or the market for that matter. Now in UUP, the dollar is also very key. We're looking at this as opposed to the DXY. But people, of course, always get super bullish at the top. And in the dollar, that was no difference. And this is a perfect reversal pattern that you had a new high, and then a reversal that same day, followed by an inside day gap down. And now as we're coming into today, another gap down. We could see here that the momentum has already broken down under the 50, and the dollar is now starting to slightly underperform the SPY. Now, this is a double-edged sword here as well, because what it really is telling you, number one, is if the dollar is top, that's giving the market a relief, but it also means cheaper commodities. So that could be inflationary. And number two is, just because it's coming off, it still has some key areas to break down. And I would say the 50-day moving average, which it broke down briefly under in August, would be the area to watch right now, or that 2870. The junk bonds, to me, is the key of all keys. And that's because with this market rally that we have right now, this is now sitting right under the 50-day moving average. So we got a second bounce. Obviously, we have beautiful support between 89, 90, and 90. That's ultimately going to be your number. But in order for it to see the bond buyers continue to buy and risk on continue to be risk on, you really now need to see this have a couple of closes over the 50 and keep moving up. Otherwise, we can say that this whole market, even if SPY is running a little ahead of itself, being over 410, is into resistance. And certainly that's the case with the Russell 2000 and the NASDAQ right now. And here you're reflected. So 94.10 would be the area to clear. But if it starts to roll down under 93 again, I would certainly get cautious. And you can see momentum is moving up on that, though. That's a good thing. So the jury's out on that, but it's certainly, to me, one of the classic indicators. Now, GLD is out of favor by a lot of people. Of course, I always keep an eye on it because, first of all, we had the second dip, new low, and a gap up. That, to me, gave us a tradable low to get into. And so right now you can see that gold is going to try to meet some resistance here. Back on these levels, it was actually outperforming the SPY. Now it's back to underperforming the SPY. Should that change? Should this clear here? Should the moving average in the real motion indicator start to clear the 50? And should our price start to tackle the 50 here and get back above, let's say, 162.50? That could go in tandem with the market for all the factors. Yield soften, dollar gets lower. More buying comes in because the indices are holding up. But at the same token, at some point, it could depart and just show that as much as people think inflation's in control, it really isn't. And that's why I'm really keeping an eye on gold very carefully, which leads us, of course, to oil, which everybody was very happy when it started to fall apart here. But this is another classic, almost island bottom here. Now, I'd say island bottom. But really, it's not perfect, A, because it's not a new low. And secondly, it did actually fill the gap from here. But nonetheless, it was a good gap up on Friday, another gap up above the moving averages. You had a mean reversion, classic mean reversion trade in price and in real motion, still underperforming the SPY. But if oil continues its climb and you see USO get back over 75, that would certainly point to a little bit more recessionary than anything else. And finally, I want to show you transportation, because this is what my major focus has been on, and especially with a rail strike potential, or at least raising the wages if they manage to prevent a strike, you want to keep your eyes here. This failed the 50. It was the first one really to get back over the 50. I was writing about it on this inside day here that it confirmed a recuperation phase. The gap up Friday was great, another gap up today, but you want to be sort of careful here that we don't get into another sort of price mean reversion trade. Momentum is looking good, though, so you also want to keep that momentum over the 200. And you do ideally want to see this start to outperform the SPY. This is your demand sector. This is where you want to see goods moving, people traveling, freight lines going. And so rather than get into the rhetoric of whether they're striking or not, I would say keep your eye on IYT. And if you put it all together, as I said, we could see equities and commodities go up for a while. But at some point, people may turn around and get spooked at that, in which case you might see another sell-off in the equities. But with this time, we could see the commodities continue to hold in place as demand destruction becomes more on the essential side again with food and energy. Okay, that's it for now. Thank you so much for watching, and I'll see you next month.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.